Mark, you like the dollar. You think it's got legs?
Yes, absolutely. Good morning, Guy. I think this is in context that FX has been really boring for the last few months. The dollar was a big story the first part of this year. It's been the key part of why the end of US exceptionalism has been a valid theme for 2025. It's been partially through the dollar component and then partially through stocks market lagging only slightly. So the dollar was a big part of the first half of the year, probably one of the most important themes, as it seemed like the world was kind of diversifying, has been diversifying to some extent. Then it's been quiet since then. We're now seeing dollars starting to break out some of its ranges on some of the most important crosses. And I think this is a theme that's got a little bit of legs into year end. There's slight upside in yields. Powell implied last week, he made a kind of a slight slip when he said we might resume rate cuts, which implied that he is definitely in favor of a pause in December. Some other speakers since the Fed meeting have come out and kind of said that as well. Given the lack of data, they are inclined to kind of pause. The private data we had in October said the economy is holding up okay in the US. So I think that with about 70% price for December Fed cut priced, there's upside in rates. That'll support the dollar move where the market is still slightly offside. So I think that's the year-end trade, and that will feed into other assets.
Mark, when it comes to feeding into other assets, I keep feeling like the correlations, the cross-asset correlations have completely broke down. You see a meltdown in gold, it doesn't affect any other asset. You see worries in private credit, it doesn't show up in the bond market. What are the ripple effects of a swing in the dollar?
Yeah, that's entirely fair, Kriti. And I sometimes I make the assumption of kind of jumping like Pavlov's dogs to the old correlations, which have broken a little bit. I go back to the idea that the underlying story that dominates absolutely everything else is AI. And I don't think that the AI bubble is close to bursting. I think we might be moving into the more volatile stage. So we're talking about, the kind of, if you want to go back to the dot-com comparison, we're going to the second half of 99 into the early 2000s, where we got, multiple 10% corrections, but ultimately the stock market doubled. Now, I'm not saying we're going to get the scale of those moves, but we're probably in a more volatile period for the AI bubble. And that is eroding correlations elsewhere because people are still programmed to buy the dip in risk assets. That said, higher dollar, higher yields is still a tightening of financial conditions at the margin. So I still think it weighs in things like precious metals and cryptocurrencies, even if it's not as strong as before.
What about the yen, Mark? Japanese markets have been on holiday today, but does the yen weakness continue on the flip side of dollar strength then?
Yeah, very much. The structural reasons for yen depreciation remain very strong. Deeply negative real yields, terrible growth outlook. Sure, there's a change in politics at the top, but that's going to take a long time to feed through. Ultimately, I think, yen continues to weaken. It's where the market is also offside on this. So dollar yen goes higher. Sure, we might see increased verbal rhetoric, pushback from officials in Japan, but they're not close to intervening yet. I think we've got to go at least above 158 before intervention is a serious risk, and maybe quite a bit above that.